DeWaal here, and this is Bridging the Week for July 27th to 31st, and today is August 3rd, 2015. Good morning. No unifying theme bridged last week's most material developments in the financial services industry worldwide. In Europe, ESMA declined at this time to find equivalency in regulation between alternative investment fund managers and funds in the United States and the European Union, and thus would not recommend that the European Commission grant passport rights to U.S. managers and funds to access EU professional investors without authorization. Meanwhile, in the U.S., 3 firms were fined in excess of $2.6 million by FINRA for trade reporting infractions, while in Hong Kong, a firm was fined approximately $580,000 for not timely reporting information regarding an apparent rogue trader. We have a lot of individual, disparate stories to cover this week, so let's get started. The European Securities and Market Authority told the European Commission last week that it was premature to grant passport rights to United States alternative investment fund managers that would enable them to manage or market alternative investment funds in the European Union without authorization by each member state where they propose to conduct business. This is because ESMA did not find equivalence in overall oversight and potential access rights under the EU and US regulatory schemes. However, ESMA said that fund managers and funds from Guernsey, Jersey, and Switzerland should be permitted to benefit from passport rights because there is equivalence in regulation between those jurisdictions and the EU. According to ESMA, if passport rights were granted to relevant U.S. entities at this time, U.S. persons would have easy access to EU professional investors than equivalent EU entities would have to professional investors in the U.S. due to registration requirements under the U.S. framework. In general, under relevant EU law, known as the Alternative Investment Fund Managers Directive, where ESMA finds equivalency, it should recommend granting of a passport. The BATS Exchange filed with the Securities and Exchange Commission for its approval a new rule and interpretation to expressly prohibit layering and spoofing type activity. In addition, the BATS Exchange seeks to adopt a new rule to provide for expedited suspension proceedings in cases involving these types of disruptive practices. The BATS Exchange is seeking approval for an express prohibition against spoofing and layering activity by members, although it claims that it currently has sufficient authority to prosecute manipulative trading conduct under its existing rules. Under a proposed new interpretation, layer would include a quote-unquote frequent pattern where a party enters orders on one side of the market at various price levels, and following the layering orders, the level of demand for the security changes, the party enters one or more orders on the other side of the market that are subsequently executed, and following the execution, the original layering orders are canceled. Spoofing would also include a quote-unquote frequent pattern where a party narrows a spread by placing an order inside the national best bid and offer, and the party then submits an order on the opposite side of the market that executes against the market participant that joined the new inside market established by the spoofing order. Goldman Sachs Execution and Clearing, KCG Americas, and RBC Capital Markets agreed to pay fines in excess of $2.6 million in aggregate to resolve allegations by the Financial Industry Regulatory Authority that they failed to comply with Order Audit Trail System reporting requirements. By the way, that's known as OATS. OATS is an integrated audit trail of order, quote, and trade information for all national market system, stocks, and over-the-counter equity securities administered by FINRA. Under OATS, FINRA member firms must electronically capture and report to OATS specific data elements related to the handling or execution of relevant orders. According to FINRA, between July 2006 to 2013, Goldman Sachs failed to transmit 6.3 billion reportable order events, or 6.1% of all reports it was required to transmit, and transmitted 42.1 billion inaccurate or incomplete order events, or 20.5% of all reports it was required to transmit between July 2006 and March 2015, among other issues. FINRA found similar issues at KCG and RBC. The Hong Kong Securities and Futures Commission fined Nomura International Hong Kong Limited 4.5 million Hong Kong dollars, or approximately 580,000 US dollars, for failing to disclose quote-unquote significant misconduct by an employee seconded from an affiliate. On June 11, 2013, Nomura disclosed to SFC that the trader has sustained a 3.3 million US dollar trading loss and had been returned to the affiliate earlier in the month. However, at the time of the disclosure, Nomura already had allegedly detected discrepancy between the trader's actual trading activities and the information he had provided to management. Among other matters, the trader had admitted to Nomura charged the SFC that, quote, he had made manual adjustments in Nomura's Hong Kong risk management system on 2 days to avoid showing the real level of loss of risk exposure from his trading activities on those days, end of quote. Nomura did not disclose the trader's inappropriate conduct to SFC until July 17th and only provided a draft report 2 days later. According to SFC, quote, Nomura and other intermediaries have a duty to report misconduct and suspected misconduct to the SFC immediately upon discovery, not when they have completed their own internal investigations into the matter, end of quote. And finally, multiple speakers, including CFTC Commissioner J. Christopher Giancarlo, called for a phased rollout of any new position limits adopted by the Commodity Futures Trading Commission during a public meeting of the CFTC's Energy and Environmental Markets Advisory Commission held last week. The CFTC proposed new rules regarding position limits on 28 commodities and aggregation in November 2013. According to Commissioner Giancarlo, quote, proceeding in a phased approach would give all market participants the opportunity to adjust to the new process of tracking and reporting commodity swaps along with their futures and options. A phased approach will also be useful for the CFTC, which will then have additional time to obtain better data about the OTC market for physical commodities, as well as conduct additional research and analysis to determine whether federal position limits are appropriate and necessary at all outside of the spot month, end of quote. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal. Have a great week and ciao.